They took their best shot: the margin hikes, the coordinated short attacks, the media blackout designed to make you think precious metals were yesterday's trade. But when silver crossed $66 on December 18, 2024, the entire manipulation apparatus was still standing, except this time it was on fire. What the banking establishment doesn't want you to understand is that the last cheap silver just evaporated overnight. Not gradually, not over months, overnight. The physical premium structure that kept the market functioning for 40 years collapsed in 72 hours, and right now, while CNBC is telling you to buy the dip in tech stocks, the most consequential repricing event in commodity market history is unfolding in real time. This is not a drill. The float is gone. The hedge books are underwater. And for the first time since 1980, silver has entered true price discovery, a condition so dangerous for short sellers that 3 major bullion banks have already restricted institutional client access to certain derivative products. While everyone was watching Bitcoin hit new highs and the Federal Reserve debate rate cuts, the real story is the complete disintegration of the paper silver market's ability to suppress physical prices. Let's be clear, what happened between December 12th and December 18th wasn't a normal rally. This was a structural break. When silver went from $61.50 to $66.40 in 6 trading sessions, while physical premiums simultaneously exploded from $1.20 over spot to $7.50 over spot, that's not bullish sentiment. That's market failure. The lie they've been selling you, that paper contracts and physical metal are the same thing, just got exposed in the most brutal way possible. Here's the kicker. The COMEX reported inventory drawdowns of 8 million ounces during the exact same period that registered silver, the metal actually available for delivery, dropped to levels not seen since 2004. This is a lie of omission so massive it borders on coordinated market manipulation. They want you to believe this is just another commodity cycle. They want you to think the paper price still matters. But every major industrial buyer knows the truth. There is no longer a functional spot market for physical silver above 50 million ounces. This matters today, right now, this morning, because the supply structure that kept silver affordable for industrial users just collapsed. Samsung, LG Energy Solutions, and Panasonic, the 3 largest consumers of silver for photovoltaic cells and battery technology, have already locked in forward contracts extending through the 3rd quarter of 2026 at prices that haven't been disclosed but are rumored to be in the $75 to $85 range. Tesla's battery supplier in Nevada just paid a 22% premium over spot for immediate delivery of 1.5 million ounces. 22%. That's not a transaction. That's panic. JP Morgan, the largest silver derivatives holder in the world according to OCC data, reduced net short exposure by 41% in the last reporting period. But here's what they're not telling you. They didn't close those positions at a profit. They covered into a rising market, which means they took catastrophic losses to escape what they recognized as a terminal short squeeze. When the largest commercial short in history is eating losses to get out, you don't fade that signal. You pay attention. And here's what makes this even more urgent. China's State Reserve Bureau just announced strategic metal export restrictions taking effect January 1, 2025, specifically targeting silver compounds used in semiconductor manufacturing. In this deep dive investigation, we are going to expose exactly how the paper silver market lost control, why the largest banks in the world are now trapped in a short position they cannot exit, and what this means for anyone holding physical metal or mining shares in the next 6 months. We're going to look at the mechanism that allowed silver to trade at artificial prices for decades. We're going to explain why industrial demand just hit a tipping point that cannot be reversed. We're going to show you the 3 major forces converging right now: demonetization panic, industrial scarcity, and derivative unwinding, that create a perfect storm not seen since the Hunt brothers drove silver to $50 in 1980. And we're going to give you the strategic playbook for navigating what happens next, because next week will be brutal, not for the price, but for your emotions when they try every trick in the book to shake you out. This is the story of how paper silver died and physical silver became the most strategic asset on the planet. To understand why this matters, you have to understand how silver pricing actually worked for the last 40 years, and why that system just broke. Unlike gold, which functions primarily as a monetary metal, silver has a split personality. Roughly 52% of annual silver demand comes from industrial applications: solar panels, electronics, batteries, medical devices, water purification. The other 48% is investment and jewelry. This creates a fundamental problem. Industries need price stability, but investors want price appreciation. So the banking establishment created a solution: a massive paper market where silver could be traded, hedged, and, most importantly, suppressed through unlimited synthetic supply. The COMEX silver futures market allows leverage ratios exceeding 100 to 1, meaning you can control 100 ounces of silver with the capital required to buy just one physical ounce. This works beautifully when everyone trusts the system, when physical delivery remains theoretical, when industrial users are confident they can always convert paper to metal. But it fails catastrophically when that confidence evaporates, and over the past 90 days, it evaporated. The warning signs were everywhere: sharply rising basis between spot and physical, delivery delays extending from 2 weeks to 8 weeks, and refineries operating at capacity while still unable to meet demand. Let's do the math, because the numbers reveal why this situation is unsolvable. Global silver production in 2024 is approximately 830 million ounces. Total industrial demand alone is 620 million ounces. Investment demand, coins, bars, ETFs, adds another 280 million ounces. That's 900 million ounces of demand against 830 million ounces of supply, creating a structural deficit of 70 million ounces annually. Where does this come from? Historically, it came from recycling, central bank sales, and above-ground stockpiles. But here's the problem. Recycling rates have plateaued at around 180 million ounces and cannot increase meaningfully without significantly higher prices. Central banks stopped being net sellers in 2022, and above-ground stockpiles, this is the critical part, are now being hoarded rather than sold. The Silver Institute estimates that identifiable above-ground investment silver totals around 2.5 billion ounces. But here's the kicker. Approximately 70% of that is held in forms that are not readily available to the market. It's in allocated storage, private vaults, jewelry, and silverware. The actual float, the metal available for sale at current prices, is estimated at just 180 million ounces, and that number is shrinking daily. Now layer in the derivative market. The COMEX has open interest representing 950 million ounces of silver. The LBMA over-the-counter market is estimated at 3 times that size. If even 5% of those paper contracts demand physical delivery, that's 190 million ounces, more than the entire available float. Do you see the problem yet? This isn't a supply-demand imbalance that higher prices can solve. This is a structural impossibility. The paper market created synthetic supply that cannot be delivered, and now industrial users are competing with investors for metal that doesn't exist at anywhere near current prices. When Samsung or Tesla needs silver, they can't wait for new mine production. They need it now, so they pay whatever it takes. This is exactly what happened with palladium between 1999 and 2001, and if you understand that precedent, you understand where silver is headed. In 1999, palladium traded at $350 per ounce. Russian state stockpiles had been supplying the market for years, providing a buffer against industrial demand growth. But when Russia suddenly restricted exports in early 2000, whether for political or scarcity reasons remains debated. The auto industry, which needed palladium for catalytic converters, was caught completely off guard. Within 18 months, palladium hit $1,100 per ounce, a 214% increase, and industrial buyers were paying premiums of 30% above spot for immediate delivery. The paper market collapsed. Lease rates went negative. Refineries couldn't source material. History is repeating itself with silver, except the scale is exponentially larger because silver's industrial applications have multiplied since 2000. Photovoltaic solar installations alone consumed 140 million ounces in 2024, up from just 45 million ounces in 2015. EV battery production requires silver paste for conductivity. 5G infrastructure build-out uses silver in every antenna and circuit board, and unlike palladium, which had substitution possibilities, platinum could replace it in catalytic converters. Silver has no viable substitute in most applications. Its electrical conductivity, thermal properties, and antibacterial characteristics are unique. This makes the squeeze potentially more severe and definitely longer lasting. This creates a cascading failure scenario that has no historical parallel in modern commodity markets. The bullion banks, JP Morgan, HSBC, Scotiabank, are trapped. They sold silver they don't have to industrial customers who need it immediately, and they hedged those short positions with COMEX futures that cannot be delivered without collapsing the exchange. If they buy physical metal to cover, they drive prices higher, which triggers margin calls on their remaining short positions. If they don't cover, they face potential default on industrial contracts worth billions. Meanwhile, every tick higher in the spot price forces delta hedging by options market makers, creating mechanical buying pressure that has nothing to do with sentiment and everything to do with risk management formulas. We've already seen 3 flash rallies in the last 2 weeks where silver gained $4 in under an hour before retracing half of those gains. That's not speculation. That's a market breaking. In Part 3, we're going to look at exactly who is on each side of this trade and why none of them can afford to back down. If you're JP Morgan or HSBC, you have 2 choices right now, and both of them are catastrophic. Option A. You continue suppressing the paper price through short selling, coordinated margin hikes, and tape painting during low liquidity hours, hoping that retail investors panic and industrial buyers find alternative suppliers. But this strategy is failing because industrial buyers cannot find alternatives. They need silver, not copper, not aluminum, not substitutes. Every day you delay covering, the physical premium structure moves further away from spot, which means when you finally do cover, you're paying $75 to $80 for metal that your hedge book valued at $62. Option B. You cover your short positions now, accept billions in losses, and let silver find its true price without interference. But this triggers a cascade. Your covering drives prices higher, which triggers stop losses on other short sellers, which creates a melt-up that could send silver to triple digits before stabilization. Wall Street sources, speaking anonymously, have confirmed that at least 2 major banks held emergency risk committee meetings during the week of December 9th, specifically to address silver exposure. One senior trader described the situation as holding a grenade with the pin pulled, hoping someone else picks it up before it explodes. They are trapped. The game theory guarantees this ends in covering. The only question is whether they cover at $75 or at $150. While the banks were trying to manage their derivative books, industrial consumers were waking up to an existential supply crisis. Let's be clear. Samsung doesn't care if silver is $60 or $80. They care about securing supply for manufacturing lines that cannot stop. A photovoltaic panel production facility represents billions in capital investment and operates on contracts with solar farm developers that have locked in prices. If Samsung can't source silver, they breach those contracts, pay penalties, and lose market share to Chinese competitors who have already secured supply through state-directed purchasing programs. This creates bidding wars that completely bypass the COMEX paper market. In November, a European battery manufacturer reportedly paid a $14 premium over spot, not for certified good delivery bars, but for industrial-grade silver granules with lower purity standards. $14 over spot for lower quality material. That's not a market. That's desperation. And here's what makes this force unstoppable. Industrial demand is growing at 7% annually, driven by decarbonization mandates that are government policy in 140 countries. You can't repeal the laws of physics, and you can't manufacture solar panels without silver. Every major automotive company has committed to EV transition timelines that require millions of ounces of silver for battery production. This demand is locked in. It's not sentiment-driven. It doesn't care about technical chart patterns. It's structural, and it's accelerating. This isn't just industrial demand overwhelming mine supply. This is industrial demand plus investment demand, plus short covering, plus China's strategic hoarding, plus derivative unwinding, all happening at once. This is a perfect storm, a pincer movement, a trap within a trap. Here's how the forces compound. Industrial buyers drive physical premiums higher, which breaks the arbitrage between paper and physical, which forces the breakdown of the COMEX pricing authority, which triggers investor panic buying because if COMEX loses credibility, there's no trusted price discovery mechanism. Meanwhile, short sellers watch their hedge ratios deteriorate daily. A bank that was delta neutral at $62 is suddenly massively short at $66, forcing emergency hedging purchases that accelerate the rally. And China? China's State Reserve Bureau has been accumulating strategic metals for 36 consecutive months. They're not speculating. They're weaponizing supply chains. When they restrict silver compound exports in January, they're not just reducing global supply by the tonnage they export. They're signaling to every industrial buyer worldwide that resource nationalism is the new paradigm. This creates hoarding behavior. Companies that normally keep 6 weeks of inventory start building 6 months of inventory. That's not 7% demand growth. That's 40% demand growth in Q1 2025. There is no escape from this squeeze because every participant's rational individual action, secure supply, reduce risk, cover shorts, creates collective buying pressure that feeds on itself. We are already seeing signs of this systemic breakdown in real-time market data that mainstream media refuses to cover. On December 16th, the silver fix in London showed a 23-cent differential between the LBMA fixing price and the COMEX spot close, the largest spread in 19 years outside of the March 20, 2020 COVID crisis. Spreads like that don't happen in functional markets. On December 14th, a mid-tier refinery in Switzerland announced force majeure on retail delivery contracts, citing inability to source good delivery bars from wholesalers. Force majeure. That's a legal declaration that performance has become impossible. 3 online bullion dealers in the United States went to call for pricing on silver products above 1,000 ounces, meaning they will no longer publish prices on their websites because the premium structure is changing hourly. The U.S. Mint suspended Silver Eagle production for 6 days in early December due to blank shortages, despite the blank manufacturer operating at full capacity. These are not anecdotes. These are symptoms of market failure. And the derivatives data confirms the panic. CME silver options open interest has exploded, with a concentration in $80 and $100 calls expiring in March 2025 that suggests institutional players are hedging for a moonshot scenario. So we have supply deficit, industrial panic, banking entrapment, Chinese resource nationalism, and derivative instability all converging. Now the question is, what do you do about it? Here's what you need to understand. If you own physical silver, you are holding an asset that just transitioned from commodity to strategic resource overnight. The window for acquiring silver at anything resembling affordable prices is closing, not over months, but over weeks. Let's be clear about the implications for different positions. If you're holding physical bullion, your cost basis is now irrelevant. Whether you bought at $22 in 2021 or $60 last month, you own metal that industrial consumers desperately need and cannot source elsewhere. You have pricing power. If you're in mining stocks, you're leveraged to a margin expansion scenario that most analysts have not yet modeled. When silver was $50, The largest primary silver miners had all-in sustaining costs around $19 per ounce. At $80, they're printing money. But here's the risk. If you're in paper silver ETFs like SLV, you need to verify that your fund can actually source physical metal for new share creation, because several smaller silver ETFs have already suspended share creation due to sourcing difficulties. The FOMO is real, but so is the risk of being in the wrong vehicle when liquidity fragments. Physical metal in your possession or shares in royalty companies that have no operational risk are the safest positions. Strategy number 1, physical accumulation priority matrix. If you're buying physical silver now, avoid collectibles and stick with the most liquid forms, 100-ounce bars, Canadian maple leafs, or American eagles. Yes, premiums are brutal right now, $8 to $10 over spot for retail products, but that premium is likely to widen further. More importantly, liquid forms will be easiest to sell when you decide to take profits. Do not buy proof coins, limited editions, or commemorative rounds. You're not collecting art. You're positioning for a supply crisis. Strategy number 2, mining stock selectivity based on jurisdiction and cost curve. Not all silver miners are equal in this environment. You want producers with all-in costs below $25 per ounce, located in stable jurisdictions, Canada, Australia, United States, Mexico, and with management teams that aren't hedged. If a miner sold forward production at $60, they just locked in mediocre returns while silver potentially runs to triple digits. First, Majestic Silver, Hecla Mining, and Pan American Silver are worth researching because they have relatively low hedging exposure and are primary silver producers, not byproduct miners. Strategy number 3, avoid leverage until after the first major shakeout. Silver options and leveraged ETFs might seem tempting when you see $4 moves in a day, but this market is being actively manipulated with volatility designed to trigger stop losses. They will try to shake you out. Friday, December 20th saw a $5 intraday range with a manufactured dump at the London close that recovered entirely in after-hours trading. That was intentional. If you're using leverage, you got stopped out at the bottom and missed the recovery. Wait for the first true capitulation washout, and you'll know it when you see it because premiums will temporarily compress and sentiment will turn apocalyptic. Then deploy leverage positions for the next leg. Next week will be brutal. Not for the price trajectory, which remains up and to the right, but for your emotions when they unleash every manipulation tool they have left. They will smash the paper market during illiquid Asian trading hours. They will flood the order book with sell orders to paint the tape red. They will coordinate negative media coverage claiming the rally is over. They will raise margin requirements on COMEX futures to force technical selling. Every single one of these tactics is designed to make you doubt your thesis, panic sell your position, and provide them with the liquidity they need to cover at lower prices. If you held silver through the dump from $64 to $61 on December 15th and you watched it recover to $66 by December 18th, you already passed the first test. You understood the game, but they're going to try harder now because their losses are compounding daily. Prepare yourself mentally. Volatility will increase, not decrease. The path from $66 to $100 will not be a straight line. It will be a violent, manipulated, psychologically exhausting grind higher, but it will be higher. We are living through a historic pivot point in commodity markets where 40 years of paper market price suppression is unwinding in real time because the physical world has finally overwhelmed the paper world. This is bigger than silver. This is about the end of synthetic supply, the return of scarcity economics, and the repricing of strategic resources in a world where governments have realized that financial weapons are just as powerful as military weapons. China understood this 5 years ago. Russia understood it 3 years ago. The West is just waking up to the reality that controlling commodity supply chains determines who has leverage in the 21st century. Silver became the canary in the coal mine because its dual nature, industrial and monetary, made it the most vulnerable to supply shocks. But copper is next. Lithium is already there. Rare earths are a Chinese monopoly. We're watching the end of globalized commodity markets and the return of resource nationalism. And if you positioned yourself in physical silver between 2020 and today, you saw this coming before Wall Street. Congratulations to the diamond hands who held through the 2021 dump from $30 to $22, who ignored the mainstream media telling them inflation was transitory, who understood that paper markets are a confidence game that only works until they don't. You were right. You are ahead of Wall Street, and now you're going to get paid.